grateful to spend time with you as always. Phil C here, and in this video I want to show you what it really takes to make a consistent profitable trader. As always, timestamps below to quickly hop around. Last week we did a trend trade on the Kiwi dollar. Let's recap that, then take a look at the trend trade strategy, what makes it valid, how to identify the entry stops and targets using Fibonacci's, remove subjectivity. There's 4 steps that will make or break you as a trader. Then let's go over what to do and what not to do, and of course have me do it for you. This was a pretty nice trade. We came in and hit target 1 and we almost came down and hit target 2, didn't we? Right down there. Entries in the right place, stops are in the right place, targets are in the right place. Almost hit target 2 and then we came up and then we got stopped out. Now we didn't get stopped out for a loss here. This is a little bit of a trade management going on. So we trade 2 contracts in the live room and we came up, we sold here. We did this in the London Market Open. So in the private client group, we took this exact same trade. We came up into our entries here. We sold it because the trend trade was valid. Stops above our cycle high right here. And then targets at a retest of the lows. And then we came all the way back down here. As we hit target 1, we take off half of the contract. So half of the position. And then we roll stops to break even, right? This is how we do it. And this is how we tested it. Therefore, that's how you must do it every day. We come down, hit target 1, we take off half of the contract, we roll stops to break even, and then we're looking for follow-on targets. That's why we use a Fibonacci extension. We're looking for where is price action most likely to extend to, and that's where we come into the 127. We don't go all the way down at the 127. Don't want to get too greedy with it. It's just before the 127 there. Why do we do that? Well, we just want to front run our orders and also be in a position where we are more likely to hit target than not. That's it. So it's stacking probabilities in your favor, which we'll get to in a moment. Then price action comes up. So we're just shy of that. You don't get them all. That's the nature of the beast. And we come back up and then we hit our entries here. We get stopped out for break even, but there's still some profit on the board from our target 1 at about 30 pips, right? Not the biggest trade, but that's a good trade because we followed our rules. Now, what constitutes a trend? Basically, we have a starting point, okay? Now we all know that price action moves down, moves up, and then we move sideways, yeah? We all know about bearish, bullish, and consolidation. Yes, we just remove all of that. And right here, we're looking at a bearish trend. So we have our starting point right here. And then we have an initial move towards the downside. Yes? Then we have price action pulling back, so we have a pullback here. And then we have price action coming all the way down to retest these lows. As price action retests these lows, this is what's known as a decision point, right? So these are structure levels. At this decision point, price action is either going to decide to respect structure and then bounce, okay? Might get one of those moves right there. Or price action may break below like this and give us a new structure low, right? Because we broke and closed below this point looking left again, which is our structure right there. Now, as price action comes down and hits the decision point, we are waiting for a lower low, lower close right here. We need price action to break and close below our lows looking left. Once we get that, then our rules are met. The criteria is met that we are now bearish, right? So as price action puts in a move towards the downside like this, we get a break and close below this point looking left, giving us a new structure low. What I explain to everyone is when I get this pattern, this human behavior with price action, because all price action is a visual representation of all market participants. Once this pattern presents itself, I'm looking for trend trades. That's it. That's the criteria. Starting point, initial move towards the downside, pullback, followed by a new structure low. Once this pattern presents itself, I'm looking for bearish moves. So this price action signals to me that it intends to go lower. Okay. So as we get a pullback back up into this level right here, I want to look for shorts. That's all I'm doing. The same is reverse. If we flip that around and we're looking at bullish trends, the same thing, right? If we get a move towards the upside, like so, and this is our starting point, right? Oops, right there. I'm waiting for a pullback here, followed by a new structure high. Again, once I see this pattern, I'm looking for, oops, that. I'm looking for moves towards the upside. So if we get a pullback right here, I'm looking for buys to retest towards the upside. And that's it. We don't overcomplicate trading at all. No need to do that. Once we have our trend trade, so once we have this behavior right here, we're looking for sells in that area right there. This is known as our sell zone. Yes? So if we're using an if-then syntax, if the market gives us a pullback here, then we want to sell at a retest towards the downside right there. That's it. And I do this over and over and over and over again. Why? I'm 50% accurate, then I'm guessing the direction of the move is going to be continuing its bearish trend. Yes? Now that's very important. If I can guess the direction of the trend, whether it's bullish or whether it's bearish, if I'm half right on the direction of the move, then I can put together a strategy and then test that strategy around that behavior. All I need to do at this point is put in entries, stops, and targets. But I can't do it in a fashion where it's always going to be different entries with different stops and different targets. That's not consistent to me. We want to put together something that is going to be testable, verifiable, and repeatable. In other words, you want a strategy where you can show other people what to do. They follow that criteria exactly, and they get similar results to you. Why do I say similar? Because our eyes pick up things differently. Therefore, we need to take the strategy and go test it ourselves to make sure that it works for us. So, if I use Fibonacci's, we can accomplish that. We can absolutely do that. We can remove the subjectivity. Now, if we have our sell zone here, we want to know that we want to sell within that area. So here's how we are going to do that. We're using Fibonacci retracements. Yes. If we get a move back up into this level, then I want to sell. Where are my entries? Fibonacci retracement. That's what we're going to look at. Swing high to swing low right there. So I take my previous high, my previous swing high to my previous swing low. That's the leg that I want to measure, right? And all I want to pay attention to is if I get a move back up into that area that I was looking at. If I get a 786 right there, then I want to sell. That's it. Now I've got my entries. Yes? So again, Here is my swing high, here is my swing low. We use Fibonacci retracements to identify our entry level. So we take our swing high all the way down to our swing low right there. Here is our 786. Right there. That is where we want to enter the market. So if we're going to move back up into our 786 right there, we want to look for entries at that level. That is where our entry is going to be. So if I take a horizontal line tool, front run our entries, right here is our entry. That is the same every single time. Our entries will never change. If we're looking at a trend trade and our entries are at the 786, from our swing high to swing low Fibonacci retracement, then your entry is always going to be the same. Once it hits the 786, we can enter the trade. Now we have our entries. The same way every single time. Where are our stops going to go? Again, we use Fibonacci retracements to do that. So we don't have to change anything here. All we want to do is drop in a line tool at the 113. Yes? So now we have our entries and now we have our stops. So let's change that to red. Like this. Entry at the 786, stops at the 113. The same every single time. Never changes, ever. This is how you remove subjectivity in your trading. This is how you make it robotic as possible. Because that's exactly what we want to do as traders, right? Entry at the 786, stops at the 113. Now where are targets going to go? Well, a retest of the lows, because again, I'm half right on the direction of the trend. I'm half right on the direction of the move. So if that's the case, then I want my targets right here at a retest of the lows. So let's grab a horizontal line tool again, drop that in and make that green right there. Now we have our entry, stops, and targets using Fibonacci retracements. And that never changes. Every single time that we get this behavior, that we get this pattern, we want to measure with our Fibonacci retracement, our previous high to previous low, to get our entries the same every single time. And your stops will be the same every single time. And we always know our targets is a retest of the lows every single time. You see that the key underlying emphasis here is every single time. Then you can use TVR. The acronym stands for testable, verifiable, and repeatable. Now you can take this and go back on any chart, any market, anywhere that you want to trade and know with absolute certainty that after you test this strategy, does it produce you a positive result? How do we know it's going to produce a positive result? Well, we identified that we're half right on the direction of the move. And if that's the case, then we want to make sure that we have a positive risk to reward profile. Here we go. Our risk is like this. Let's get rid of that. We have this much risk for this much reward right there. So we have over 1.5 to 1 risk to reward on our target 1. That means we have a positive risk to reward profile. I'm walking you through step by step how we do this and how we set it up. We know that from this prior human behavior, this pattern, we know that if we get a pullback after that, then we're 50% accurate on guessing the direction of the move. And if that's the case, then we want to always put in the same entry, stops, and targets that have a positive risk to reward profile, as you see right here, over 1.5 to 1 risk to reward on target 1. And also, we do a Fibonacci extension from the same leg, swing high to swing low, back up in like this. And for target 2s, we're looking for a 127 right there. So if I drop in a horizontal line tool, like that. So we have target 1 as a positive risk to reward profile and target 2 as a positive risk to reward profile. And I use the analogy that if you had a coin, heads you win, tails you lose, and you flip that coin. So we're risking $1 to gain $1.50, right? And 50% of the time it lands on heads. My question is always, how many times do you want to flip that coin? As many times as humanly possible, right? So if you're half right and it lands on heads 50% of the time, and every time you win you get $1.50, and every time you lose $1, then of course we do want to flip that coin as many times as possible. And that's exactly how we want to set up our trading. That's exactly how you want to design your trading. By using TVR. Is it testable, verifiable, and repeatable? Then over 100 trades, you will know those numbers. Does your trading strategy give you a PE above 0? If it does, it means you have a winning system. If it doesn't, it means you have a losing system. And what a PE is a positive expectancy. A mathematical proven probability that you gain more than you lose. And that's exactly what we've done here in our setup. All right, so back to the charts. And what I've done is clicked on Bartic replay. That's why I got this scissors with me here. All I want to do is just use the scissors and cut this, because I want to show you how we do that. So here we go. We have our starting point up here, right there. And we have a move from swing high to swing low right there. And then we have another pullback back up into look left structure, followed by another move towards the downside right here. And what do we have? A break and close below our structure looking left right there. So we have a new structure low. After a new structure low, what do we want to do? Take our previous high to previous low, grab a Fibonacci retracement tool, swing high to swing low, identify where we would like to get involved if price action pulls back towards the upside. Again, this is the behavior that we're looking for. So now we have our Fibonacci's on the charts. We have identified our entry at the 786 and our stops at the 113 right there, and our targets at a retest of the lows right there. That's it. Okay. So here we go. We grab our dealer thingy, short position, and we drop it in at the 786. Our stops will be at the 113. So entry is the same, stop is the same. And for targets, we have a retest of the lows right here. Okay, don't want to get greedy with it. Don't want to go all the way down here, right? Don't want to get greedy with it. You want the highest probability that you will be filled, that you will hit targets. Important. So always leave a bit of a gap there to account for the spread. That's it. But we do it the same way every single time. I want to emphasize that so we can follow the process of testable, verifiable, and repeatable. So not all the way down here, just leave a bit of a gap there to retest the lows. You have over a 1.5 risk to reward profile, right? You clone, copy, and we know from this example that we didn't hit target 2, but you take the same leg with a Fibonacci extension, like so, and then we know that we want a 127 right down here at target 2. Yes? Right. So as price action pulls back, right here, we finally get involved. We finally get our entries right here at the 786. Now, all you need to do here is leave it alone. We don't touch it. We've identified our entry stops and targets here. That's it. Once price action has come up into your entry and you are now involved in the trade, then one or two things is going to happen. Price action is either going to hit your targets or it's going to stop you out. And you've accepted that risk already. Otherwise, we're not putting the trade on to begin with. We've already accepted that this trade could be a loser. We're half right on this. So half the time we're going to be stopped out. Half the time we are going to hit targets. But as we've clearly gone over, when you hit targets, you have a positive risk to reward profile. So you gain more than you lose, right? So you only have to be half right. But once the trade's on, people get a little bit emotional with it, right? They start to change their targets, they move it around, or they change their stop if price action is moving towards their stop. You don't want to touch anything. Don't change anything. We want to stay strict to the plan. That's it. Strict to the criteria. That's it. We be patient and let price action dictate whether it's going to hit target or stop. And when you do that, you have full faith and belief in your trading plan. It's emotional liberating feeling to have that and to trade in that way. Now, a lot of retail traders don't have that. But if you follow these steps, you will position yourself to be in that state. Now you have an advantage over the majority. I can guarantee you that. So, back to our example here. As we enter the trade, one or two things is going to happen. Be patient. Don't do anything. Just let price action do its thing. As you come down and you hit target 1, all you want to do at this point is take off half of the position, like so. Roll stops to break even, like so. And let whatever happens, like so. Okay? And again, with this example, we know that we didn't come down and hit target 2. That's okay. You took off some profits on the board, and then you got stopped out for break even on target 2. But you walked away from that trade profitable because you followed the steps. There are 4 steps that we want to do that makes or breaks any trader, right? Strategy, test, analyze, results. Once you have your strategy, then you want to take that strategy, go to a pair that interests you, so euro dollar, go to a time frame that interests you, say the 1 hour time frame, and then you want to test that trade 100 times. Because ultimately what we need now is an average. What you'll find after that is you'll know how many times you were right, so your win percentage. And then you'll know how many pips you gain when you won and how many pips you lost when it was a losing trade. And that's it. That's all trading is. We don't have to overcomplicate anything. That is what will make or break you as a trader. What not to do is just do the opposite, like the majority of traders. That's what not to do. If the byproduct of doing what I've mentioned here correctly is positive results for you, and those positive results are profitable results, which is why everyone is here anyway, which is why you are watching this, which is why you were interested in getting educated as a retail trader, looking to day trade and become consistently profitable. If you follow strategy, test, analyze, results, if you follow STAR, then you can achieve that. It doesn't necessarily have to be with me, but at least you know the steps now. You can take that on your own accord and go out and do this. Absolutely. If you do that, I promise you, the attainment of what you want out of trading is absolutely inevitable for you. You can do this. And I wholeheartedly wish that for you as well. If you do like this style of trading, and you do want to go through that exact process that I've outlined for you here, and what I would highly encourage you to do is just go down to the description below, sign up for the Start Classroom, so get involved there. What will happen is you have access to all the education material leading up to the trend trade. And also on the front page, you will have access to a Zoom link where you can book a call with me and we can sit down together, assess where you're at, come up with a tailored plan for you so you have absolute clarity in what you need to do, and we can do that together. That way, you know exactly what you are doing in the next couple of months to make changes in your own trading. Otherwise, continue going about doing what you're currently doing, which can be disastrous because unless we change something, nothing is going to change for us. So if you want to do that together, then get involved below. Other than that, I will see everyone in the live room, which is in about half an hour from now. And until next time, be safe, enjoy life, and I'll talk to you soon. All right, thank you so much.